Welcome to Crypto Yield Pro, your ultimate guide to turning market chaos into profit streams. Today, we're diving into a strategy that could redefine how you approach crypto trading. Arbitrage. Imagine making consistent profits while others sweat over price swings. Sounds like a dream, right? But this isn't just wishful thinking. It's a proven approach top traders use every single day. Most people overlook these methods, or worse, they don't know where to start. That's where this video comes in. I'll reveal step-by-step how to harness strategies like funding arbitrage and spread arbitrage to secure yields and mitigate risks like a pro. Curious to know how bots and market conditions play into this? Stick around, because what you're about to learn could change your game entirely. But first, hit that like button, subscribe to the channel, and turn on notifications for more daily exclusive tips and strategies. Let's unlock the secrets of crypto arbitrage together. Picture this. You walk into a store, find an item priced low, and then spot the same item online for a higher price. What if you could pocket the difference? That's arbitrage in a nutshell. In crypto, it's even juicier because the opportunities are endless. Two of the big players? Funding arbitrage and spread arbitrage. Funding arbitrage works like this. You're earning yields just for holding positions without sweating market fluctuations. Spread arbitrage, on the other hand, is about spotting price gaps between spot and futures contracts. It's like finding a $20 bill on the ground, except in this case, it's a lot more strategic and rewarding. Now, why does this matter to you? Because crypto markets are global and open 24/7, creating constant price imbalances. That's your playground. But not everyone knows how to jump on these opportunities. Stick with me, and I'll show you how to grab them before someone else does. Curious yet? When someone mentions delta neutral, it might sound like rocket science, but it's actually simple once you break it down. Imagine holding Bitcoin in one hand and betting against it in the other. It's like balancing a seesaw. You're immune to price swings. Here's how it works. You buy Bitcoin on the spot market, locking in your long position. Then, you sell an equivalent amount on the futures market, creating a short position. When combined, these two positions cancel each other out. No matter where the price goes, you're set. But what's the payoff? That's where funding fees come in. More on that in a moment. This strategy isn't about riding the waves. It's about staying steady and skimming profits while others battle the tides. Here's where the magic happens. Funding fees. Think of them as the financial glue between your long and short positions. When you're shorting in the futures market, you might actually get paid for it. Sounds like free money, right? Well, almost. Funding fees are charges that traders on either side, long or short, pay or receive, depending on market demand. When there's a rush of buyers, longs typically pay shorts. This is your bread and butter in a delta neutral strategy. It's all about consistently collecting those fees while staying market neutral. But here's the twist. Funding rates fluctuate. In bullish markets, shorts often rake in higher payouts because demand surges. However, in bearish trends, roles can flip. Mastering this flow is what separates casual traders from those who truly know how to milk these opportunities. Let's talk risks, because no strategy is foolproof. First up, platform dependency. Centralized exchanges like Binance or OKX are great tools, but what happens if they face downtime, hacking, or regulatory clampdowns? You're essentially putting your faith and funds in their hands. Then there's execution risk. Arbitrage requires precision timing. A delay in placing trades, even by a few seconds, can turn a winning trade into a loss. Imagine the frustration of seeing profits evaporate because of a slow connection or a lagging platform. Finally, opportunity risk can sting the most. Sure, arbitrage yields hover around 7 to 10%, but Bitcoin's annualized returns? Sometimes upwards of 50 to 60%. If the market's in a bull run, you might end up kicking yourself for playing it safe. But hey, every choice comes with a trade-off. Enter the game changers. Automated bots. Platforms like Binance and OKX offer powerful tools to automate arbitrage strategies, making life easier for traders. These bots are programmed to spot opportunities, execute trades, and even monitor funding rates, all while you sit back and sip your coffee. For example, Binance's trading bot can automatically calculate how much to allocate in spot and futures positions for a delta-neutral strategy. Want to earn that 10% annual yield without lifting a finger? Just set it up and let it run. It's like having a personal assistant that works 24/7. But don't get too comfortable. Bots aren't perfect. They rely on algorithms and platforms. If the market shifts suddenly or the platform has downtime, you could still face losses. Think of them as smart tools, not invincible heroes. Ready to explore another way to win the game? Spread arbitrage is a little like playing the gaps. It's about capitalizing on the difference between spot prices and futures contracts with fixed expirations. Imagine buying Bitcoin at today's spot price and simultaneously selling a futures contract that expires in 3 months, locking in a profit if there's a spread. This method works because futures prices often reflect market sentiment. For example, in a bull market, futures prices can run higher than spot prices due to anticipated growth. By taking both sides of the trade, you're not betting on price direction, but cashing in on the spread. However, there's always a catch. Market conditions can shift, compressing or widening the spread unexpectedly. Plus, these trades often lock up capital for weeks or months, which could limit your ability to pivot quickly. But when done right, spread arbitrage can be a rewarding piece of the crypto puzzle. Market conditions are the invisible hands that shape your profits. In bull markets, everything seems to soar, including funding fees. When demand pushes futures prices up, shorts often pocket higher payouts, making strategies like funding arbitrage exceptionally lucrative. Conversely, bear markets can be a different beast. Funding fees might drop or even turn negative, meaning you could end up paying to hold positions. Here, strategies like spread arbitrage may offer more stability since they focus on locked-in spreads rather than market sentiment. Understanding this dynamic is crucial. It's not just about picking a strategy, but knowing when and where to deploy it. Timing is everything, and adapting your game plan to the market's rhythm can mean the difference between a modest yield and a windfall. Now it's time to take action. Dive into platforms like Binance or OKX, test out automated bots, and start small if you're just getting your feet wet. Remember, success doesn't come from watching, it comes from doing. Here's a thought to leave you with. What would an extra 10% yield mean for you? How could it impact your portfolio or even your long-term financial goals? Think about it and start applying what you've learned today. For more in-depth strategies, exclusive tools, and even my perfect DeFi portfolio, grab my ebook. It's pinned in the first comment of this video. It's the ultimate resource to fast-track your journey toward financial freedom. Plus, if you're serious about optimizing your trades, use my referral link for TradingView and get $15 off any plan. It's a win-win that supports this channel and keeps the daily content coming. If you found value in this video, don't forget to like, subscribe, and turn on notifications. Let's keep building, keep growing, and I'll see you tomorrow. Cheers to your success.